Hello and welcome back to another demo video series dealing with Chapter 6. So Chapter 6 dealt with variable costing and it talked about segment reporting. So right now we're just going to look at absorption costing and variable costing. Now if you look on the screen here, this is exercise 6-1. And 6-1 is on page 286 and on page 287. So what we did here was we created a template so we can figure out what the unit product cost is under each method. Okay. Hopefully by now you've read the chapter, you answered the study guide questions, and you know that the main difference between absorption costing and variable costing is how do we handle fixed manufacturing overhead. Under absorption costing, fixed manufacturing overhead is part of the product cost. Okay, it's an inventoriable cost. What that means is we recognize that cost as an expense only whenever we sell it. Okay, so when we make a bunch of products, those products are on our balance sheet under finished goods account. Okay, we don't recognize that $700 cost until we actually sell that unit. Okay, so the absorption cost, it uses all the product costs that we're familiar with, right? Direct material, direct labor, and manufacturing overhead. And when I say manufacturing overhead, I'm actually referring to both pieces of manufacturing overhead, meaning the variable portion and the fixed portion. Okay, so you'll notice here that in the book they gave us direct material per unit, they gave us direct labor per unit, and they also gave us the variable MOH per unit. They did not give us the fixed manufacturing overhead per unit. We needed to calculate that. So if you're ever asked, how do you calculate fixed manufacturing overhead? Well, that's easy. You take the fixed portion of manufacturing overhead, which they're going to give you, and you divide it by the number of units produced during the period. I'm going to say that again because that's really important. The number of units produced during the period. Okay? Because if you notice in the book, we made 250 units, but we only sold 225. Okay, so we need to, under the absorption method, we need to allocate that fixed portion to all the units that we produced. Okay, so under the absorption method, we have a unit product cost of $700. Now, under the variable method says when we're trying to figure out or when we're trying to calculate the unit product cost, we only use the variable product costs, meaning direct material behaves in a variable fashion, direct labor behaves in a variable fashion. Obviously, variable manufacturing overhead is variable and behaves in a variable fashion. Those are the only three costs that become part of the unit product cost. So we could see here that under the variable costing method, the unit product cost per unit is $460. That's a difference of $240, right? $700 unit product cost under absorption minus the unit product cost under the variable method, $460, gives us $240. Okay, we already know under the absorption method that $240 of unit product cost is sitting on the balance sheet, and we only recognize it when we sell that unit. So you might ask, well, under the variable costing method, what do we do with that fixed manufacturing overhead? Under the variable method, fixed manufacturing overhead is considered a period cost, meaning we recognize that expense when it is incurred. Okay, Under the variable method, the fixed manufacturing overhead costs flow directly to the income statement. Okay? That differs under the absorption method, because under the absorption method, that fixed manufacturing overhead goes to the balance sheet, stays there until we sell that unit, then it flows to the income statement. Okay? Now, very important, we're using the variable costing method. Okay? You might say, well, why don't I include variable selling and administrative as part of my product cost? That's because selling and administrative costs are always period costs. Okay? They're always expensed when they're incurred. Just because we're using the variable method doesn't mean that we take a variable period cost and make it part of our product cost. Okay? So the takeaway here is twofold. One, how is fixed manufacturing overhead handled? Well, under the absorption costing, it's an inventoriable cost. It's part of our product cost. Under variable method, it is a period cost, and it flows directly to the income statement. Regardless of when we sell it or not, sell that unit, it doesn't matter. We say fixed MOH is a period cost. Okay, that's number one. The second takeaway is knowing that under this variable method, we only use variable product costs. Okay? Just because we're taking the fixed MOH, which is a product cost, and viewing it as being a period cost, that's okay. That's what we're supposed to do. But when you see variable, don't take when you see the variable costing method and you have to calculate the unit product cost, never ever take a variable period cost and say, oh, it's part of my product, because it doesn't work that way. Okay? Let's work through exercise 6-2. Okay? Now, 6-2, I just want to point out a few things. 6-2 wants us to take the information from exercise 6-1 and they want us to create a contribution formatted income statement. That's not a problem, right? We already know how to do that. We already know that the contribution formatted income statement, or the variable income statement, whatever we want to call it, segregates variable from fixed costs. Okay? We already know that we're going to take our variable cost of goods sold. In order to figure that out, we need to take the number of units we sold, 225, and multiply it by the variable unit product cost of $460. Okay? Since we're doing the variable income statement, or the contribution formatted income statement, we need to next look for our next variable cost, which is the variable selling and administrative, right? Problem tells us, hey, that's $20 per unit that you sell. Okay, well, we sold 225 units, so let's recognize that expense. That's $4,500. We subtract we subtract the variable expense from our sales to end up with our contribution margin. Then we subtract out our fixed expenses. Because we're doing the variable method, we're recognizing all of the fixed manufacturing overhead, all $60,000. Okay? Under the absorption method, of the fixed manufacturing overhead, we only recognized $54,000. How did you get that? Well, the problem asks us in part 1, under absorption costing, how much fixed manufacturing overhead cost is included in the company's inventory at the end of the year? Well, I know that my fixed manufacturing overhead per unit is $240. I need to figure out how much of that is still on the balance sheet. 25 units at $240 a pop, that's $6,000. Okay? So notice what my net income is, or net operating income is, under the variable method. It's $3,250. Okay. The problem in the book tells us that under the absorption method, your net operating income is $9,250. That's great. There's a difference of $6,000. Why? Because it's how we view the fixed manufacturing overhead. There's a $6,000 difference between net operating income under the absorption method versus net income under the variable method. Okay? Why is the variable method lower? It's because it recognizes all of the fixed manufacturing overhead cost in the period in which it's incurred. The absorption method says we're only going to recognize the fixed manufacturing overhead of the units that we sell. The units that we don't sell, that cost still sits on the balance sheet. It's an inventoriable cost. Okay? So that's exercise 1 and 2. All right? When we come back, I want to do exercise 6-3, and I want to take a little bit of time with this, okay, to really understand it. And we're going to present a reconciliation statement. So come back for our next video, and we'll cover exercise 6-3.